This presentation, titled Audit for Risk Management, or Can Your ISO 9001 Audit Save You from Disaster, comes to us from Paul Simpson. Paul is the current chair of the ISO TC 176 Subcommittee 2, the group responsible for maintaining ISO 9001, among other standards produced by the ISO Technical Committee. He also supports the development of standards for auditing, health and safety, and conformity assessment. Paul is an experienced developer of systems within organizations. With a first degree in engineering, he has extended his postgraduate qualifications into fields of marketing and business, as well as professional areas of auditing, health and safety, and quality. Throughout his career, Paul has been applying quality principles for risk management, quality planning, and business improvement to enable organizations to move forward with control. And with that, take it away, Paul.
Thank you, Mike, and thank you to the team at Exemplar for inviting me to present to the Expo. Very pleased to do so, and hopefully you'll get some value from the presentation. As Mike said in his introduction, I've been around the block a bit and have seen the evolution of quality management and of audit over many years. I started my career in quality control and have had roles in quality engineering, as well as working for third-party audits, both as a full-time employee as a contractor. So I've seen the use of audit in a range of different circumstances, and that's the area that I'd like to share with you today. The title of the presentation, as you can see, is Auditing for Risk Management. So we're looking at the opportunities that audit presents to manage the risk to organizations. And the examples that I'll present to you are pretty much disasters that have occurred in the public domain. And I'll hopefully highlight to you from evidence that's come out of the investigation of these disasters, where the role of audit could or should have prevented the disasters. So firstly, let's talk about audit in context. So when we're thinking about audit, we're looking at it in the terms of the management system that the organization uses. And in this case, the quality management system. So that's how does the organization arrange itself and operate its processes to be able to deliver those products and services to customers. We're looking particularly again at the clauses within ISO 9001 to do with performance evaluation. And ISO is based around that plan, do, check, act cycle. And audit, as part of performance evaluation, is embedded in that check part of the cycle. And when we look at audit, we're looking at the audit program. So what is it that we're looking to do across the organization? Where are the areas of risk that we need to focus on? Where are the areas of operation that could create these pinch points, these disasters that are waiting to happen if we don't prevent them? And we'll then look in detail at the planning of audits and how they might be carried out to prevent those audit disasters from happening. And the other thing I'll mention to you is the 4P model of quality management. It's my own model that I use for management systems and for quality management systems. It isn't something that TC 176 supports. And in this presentation, the 4P model isn't part of TC 176. I say it's mine. They're aware of it. And similarly, the views that I have on audit are my own, and they're not the views of TC 176. So just to let you know that. So firstly, a quick overview of the 4P model. The 4Ps is made up of 4 principles. So customer satisfaction is our purpose. Within quality management, we're interested in delivering those products and services that the customer needs. So what is it that they want? What is it that they need? The second P is systematic process design and management. So how do we go about organizing the organization to make sure that it continues to deliver those products and services to meet the customer requirements? And the third P is right people, and the right place. So how do we ensure our people are competent? How do we ensure they're aware? And how do we ensure that we communicate with them the purpose, the processes that we expect them to operate to? And the fourth P is the focus on performance improvement. So we're looking at how does the organization get feedback on how well those processes are operating, how well its people understand quality management, how well do they understand those customer requirements that are generated from our purpose as an organization. And we run through each of those four Ps and look at it in the view of what I call the warning signs, so the disasters that are in the public domain. And again, we'll come back to, and how will audit have supported each of those four Ps to deliver effective quality management. So our first P, as I said, is purpose. And for quality management, this remains customer satisfaction. So for other management system standards, they're structured around, for example, health and safety management, environmental management, and all of those have different interested parties, different stakeholders, and different needs. But for quality management, and for each of the cases that I bring to you today, customer satisfaction is what we're interested in, and delivering those processes robustly to enable the customer satisfaction. In the notes that you'll have available to you at the end, there is a couple of quotes, one from Peter Drucker talking about the main purpose of an organization is to identify and satisfy a customer. And that, as I say, remains the focus for quality management. So my first warning sign, and the case study that I've picked up on is the 2008 financial crash. Now we're sitting here in the middle of a global crisis. The COVID-19 pandemic is around us, and it's useful sometimes to think back to some of the other crises that we have been through. Certainly when we're looking at audit was derived as a result of the financial crash, the Wall Street crash of the 1920s. So audit has evolved from those kinds of disasters. And there may be opportunities when we look back at this pandemic to have seen some of the warning signs there and to apply the lessons learned. But the example, as I say, I've chosen is the 2008 financial crash. And it's worth again looking at the purpose of what finance is for and what banks do. So I've highlighted two simple requirements for banks. The first thing is you give them your money and they hold on to it until you need it. And the second thing they do is that if you need more money than you currently have, they lend you that money in the form of a mortgage until such time as you can pay that money back to them. And they balance that across the business to make sure they have sufficient funds to cover the loans, the mortgages that they've lent out, and they can provide the cash to their customers. So it sounds very simple, but when we look back at the review of the 2008 financial crash, a whole range of processes that operate across the financial sector did not work as they should. And the main reason that they didn't work was that the banks lost sight of their purpose, and that is to hold funds and to loan money to people who could afford those funds. And again, in the notes that you'll see, there are a range of different groups that have been picked out who failed in that process. And essentially, the financial system lost sight of its customers. So the people that asked them to hold money and the people that applied to them for mortgages, for loans. So how could audit have helped? I say this will make more sense when you have a look at some of the content of the notes that sit behind this presentation. But essentially, there is a regulatory requirement for audit across the financial sector, derived from the financial crash of the 1920s. But all organizations have to have audits to demonstrate they are a going concern and they can operate in the sector that they do, and in this case, in finance. All financial organizations have those processes in place. They have external auditors who come in and say, yes, your business is viable, and yes, you are a going concern. Now, all of the organizations that we'll be talking through have those audits, and those audits did not pick out on the fact that they were lending out more money than they had access to. And I give you one example, again in the notes in more detail, but I'll mention it here. It was the role of Halifax Bank of Scotland in the UK. And there was a whistleblower called Paul Moore. Paul Moore was the head of group regulatory risk at HBOS. So he had a team of people looking at the policy, looking at the processes, and looking at records of loans that the bank was making and the controls in place for those loans. In 2004, HBOS was expanding too fast, and it was based on unsustainable lending and the sale of financial products such as payment protection insurance. So Paul, correctly in his role as the head of audit, repeatedly mentioned this to the chairman and chief executive of HBOS. And there was a quote from the investigation or from Paul Moore's book, which said that one of the employees in a bank in Scunthorpe said to him, Paul, we will never reach our sales targets and sell ethically. So there are a whole host of people within the organization that recognize this problem. And Paul, as head of audit, raised this at the highest level. A week after he had made his warning to the board, he was summoned into the boardroom again, and the CEO fired him. Again, to cut a long story short, Paul applied for unfair dismissal, and he was paid off with a £500,000 compensation. And he, as part of that settlement, he had to sign a non-disclosure agreement, and that applied for all the time that Paul was looking for work. And at that time, the financial crisis hit. Now, bearing in mind that Paul had been raising this with the board for many years, he recognized that his non-disclosure agreement allowed him to go to government as part of the Treasury Committee investigation into the financial crisis and present information to them. And he presented something like 5,000 words worth of information, and he appeared before the Treasury Select Committee. And the end result with this was that he shone a light onto the controls in operation within the finance sector, to the point where he was highlighted within the Treasury Select Committee report as being a model for how the finance sector should have been looking after itself. So again, all of these processes are in place within organizations. They have existing controls that show how the organization should be operating. Audit is there to highlight those points and to raise them back with the organization. So the second P is systematic process design and management. And the idea here is that as quality professionals, we're there to ensure that the processes in place are robust. We're there to challenge the activity within the process to see that each activity adds value and manages risk. We work with the people to ensure that they are operating to those processes. And we look to see that the process measures are giving us that feedback to say that the process is working well. So for my warning sign, I've chosen the Deepwater Horizon, the Macondo explosion. Again, in the notes that you'll have after the presentation, there's a lot of detail about the timeline from February 2009 to the actual accident in April 2010. And it will highlight the process from BP applying for a license with the regulator for the Bay of Macondo, and for the operation of the exploration and setting up of the well within the Deepwater Horizon tragedy. There's a whole series of steps within that process, and there's just a couple that I'd like to highlight to you. The first one was that the requirement from the regulator is for BP to make an application for a license, and as part of that license they highlight emergency plans of what to do in the event of a spill. And the records that are in the public domain, and again there's a link in the notes, show that the oil spill response plan that BP presented included elements such as how to deal with seals. It also made reference to a Japanese bank, none of which were relevant to the Macondo exploration that they were looking for. So the evidence, the records that were available at the time showed that this was a bit of a cut and paste for the BP as the exploration company. Similarly, BP's partner in this disaster was a company called Transocean. And as part of that selection process to choose Transocean to operate the Deepwater Horizon rig, which they Transocean owned, they should have looked at Transocean's record in the Bay. So at the time of the accident, Transocean were responsible for something like 50% of the investigations by the regulator into oil spills in the Bay. And they had something like 40% of the rigs. Whereas previously they had a proportional responsibility for spills in the region. So there was warning signs there that Transocean perhaps had a history of not operating in accordance with the regulations, in accordance with the laws. And the third point I'll make here is that as part of the operation of the rig, BP had a safety audit of Deepwater Horizon back in 2009. That audit of the rig identified a series of failures, significant safety related failures for the rig. A total of 390 repairs were identified, and a total of 3,500 hours of work were required to operate the rig. And yet the record showed that Deepwater Horizon had not returned to port to have any of those repairs carried out between the time of the audit and the time of the disaster. So there are just three examples of how the process from February 2009 to April 2010 indicated opportunities for corrective action. So yeah, audit processes were in place, but the findings were ignored. The controls were in place, so selection of suppliers, but they weren't effective. And all the feedback mechanisms that showed that the rig was under pressure for time were there, but were ignored. And my third principle, right people, right place. I've chosen as an example Toyota. So Toyota have a house of quality that they base their Toyota management system on. The two pillars of that management system are continuous improvement and respect for people. And that's based on respect for individuals within that second pillar and also team working. So if we are to operate our quality management system effectively, we need both those two pillars to be working, and that relies completely on having engaged, motivated and competent people. And for my third warning sign, I've chosen as a case study the operation, the prosecution of a pediatrician, Hadiza Bawagaba. So it's a very tragic case of a young individual, a young patient who died in the course of a day's attendance at a hospital in Leicester. There were a whole series of opportunities to correctly identify the causes of the problems that he was facing. Um, but what happened was, rather than look at the process that was in operation at the time and the working conditions in operation at the time, they chose to focus on the individual and to put blame on both Hadiza Bawagaba and one of the nurses on shift at the time. So they took no account of all of these workplace workload issues and chose to focus on the individual. So Hadiza Bawagaba in particular was prosecuted for manslaughter, was convicted, she was struck off the medical register, and yet all in the background there was evidence that the whole process itself was failing. So again, the purpose of audit, which we'll come to in a second, should be to highlight those systemic failures and to look at the system rather than the individuals. So in terms of how audit could have helped, one of the findings in the investigation was that Hadiza Bawagaba had just returned from maternity leave, and there was not a process in place to return her to her place of work. She was actually covering for a range of doctors on the shift that she was operating. The consultant who should have been there to support all of the decisions that she was making was not available. She was covering, I think it was 4 floors in the hospital and a total of 7 wards. So you can get an impression of the workload that she was under. And similarly, it wasn't the fact that she, although she has owned up to a number of mistakes on the day, that she made a mistake that led to this fatality, but there was evidence that the whole of the systems within the hospital were not operating as they could. And again, in the slide, there is a link to sort of mortality figures. And for this particular hospital in Leicester, the mortality figures were significantly higher than the national average. So audit could have helped by identifying some of those underlying conditions. And in particular, at this hospital in Leicester, there were a whole series of peer reviews that were carried out, which indicated failings within the system. And after this event, the hospital did some more review work on cases of higher than expected mortality and found something like 25% of those cases, there were significant failings in the treatment that had led to this death. And of the cases that they looked at, there was something like 50% of them where they said there were lessons to be learned. So again, if you have an audit process that is looking at all of those activities, looking at all of those processes, there are these opportunities that could prevent disasters and, in this case, tragic fatalities. And for my final principle, a focus on performance improvement. So this is all the feedback mechanisms that the organization has. It's gathering of data that tells it how well it's doing, whether it's on track to meet its objectives. It is a way of sort of evaluating the effectiveness of the system as a whole and putting forward those findings for action. And my final case study is the Mid-Staffs NHS. Again, it's a local UK, again, a very tragic story. It's a public investigation into the findings of high fatalities and complaints about this particular National Health Service Trust. So it's a report that was carried out by a barrister, so Robert Francis QC, and some of the lessons that are learned, again, there is a link to the report. There were multiple measures in place within the Mid-Staffs NHS Foundation Trust. All of those measures were indicating that the trust was not online to achieve its objectives, which is to treat patients safely and to return them back to their daily lives. They found evidence of gaming of targets. So if there was a target, people would do everything they could to meet the target, but not to address the needs for patient safety. And again, similarly to the Leicester Hospital that I mentioned, there were a whole series of peer reviews in areas of patient care that identified that mid-staffs was not performing as it should. And other feedback mechanisms that we'll see, employees. There were a series of whistleblowers and people complaining about their conditions and the processes that were in place. And again, no action was taken. And audits themselves of the trust in preparation for its foundation trust status indicated failures within the trust. So how could audit have helped? The overriding thing is act on the feedback, act on the findings of your audits, of your peer reviews, of your complaints. Make sure that those processes are improved and made more effective to deliver those performance targets that you're looking for and manage the risks to the patients. There's a whole series of peer reviews. And again, if we're doing an internal audit program across the trust to look at those peer review requirements, look at the inpatient surveys, look at the staff surveys, evaluating whistleblowers, they would have highlighted all of these problems. So we just need to act on the findings of our audits. So just as a quick summary then for audit, it does support each of the 4 Ps. Hopefully, as I've gone through in a very quick presentation, it supports purpose. So how does the organization get its purpose out to its employees? We can audit that. We can look to see how well that is going. We always audit our processes. So making sure that those processes from start to finish actually deliver what they should do. We're auditing people. So we're not focusing on the people within the process, but we're looking to see that people understand, see that they have the right working conditions to be able to do their jobs to the best of their abilities. And again, we're looking at our own feedback mechanisms. By auditing those performance feedback mechanisms, we can identify whether they're effective or not. And as I mentioned at the beginning, audit is part of that performance clause, part of the checking of the Plan, Do, Check Act. It's built into all the ISO management system standards under clause 9, performance evaluation. Audit should be a strategic tool. So, you know, if we are doing all of this activity to look at our purpose, look at our people, look at our process and look at our performance, that should go to the top, because it gives the top management an indication of to how well that system that they are funding and supporting is doing for them. There's another model which I've stolen from the finance sector. They talk about 3 lines of defense, and the 3 lines of defense are your operational teams. So back to the finance sector, these are the people who are making the loans. You know, back to Deepwater Horizon, these are the people who are making the license applications. These are people who are operating, you know, the drilling rig. The second line of defense is the professionals. So in our case, the quality professionals that design the systems, the quality professionals who, as auditors, audit the systems. We are part of the second line of defense. And the third line of defense is that independent audit. And this is where we rely on the certification bodies, the QMS certification bodies, to give us the feedback that says that our systems are operating well and are effective. We shouldn't lay all the blame on a CB if we have a problem, because we have these other 2 lines of defense, but they do exist to give us accurate feedback. And the final point there in terms of a summary is audit is a form of mitigating risk. So by looking at the risks across the organization, we focus on the high risk areas, those things that can create the disasters that, you know, that bring down the organization. There are many cases that I haven't chosen to use in this presentation of organizations that have failed because of the lack of control of risk. In the finance example I gave at the beginning, Lehman Brothers in the US, Northern Rock Building Society Bank in the UK, both of those organizations failed because they weren't managing their processes. So in essence, that's the purpose of the presentation. The audit is there as a strategic tool to manage the risks within the organizations. We just need to use it well. Okay, again, in a face-to-face presentation, I'd give an opportunity now for questions, but certainly in the slide pack, if there's anything in the presentation that that you find useful, please do use any of the contact details to get in touch with me and ask any questions about the role of audit as part of a quality management system. With that, I'll hand back to Mike and basically, yes, thank you for watching. Thank you for taking the time. Enjoy the rest of the expo. And thank you again for inviting me to make a short presentation.
Thank you, Paul Simpson, for that perspective on risk management and ISO 9001 auditing. And that concludes this presentation.